Hi, everyone, and thank you for joining us today at this year's Digital Asset Compliance and Market Integrity Summit. For those of you who didn't join us last year in New York, we've expanded this year's DACOM into a bi-weekly series that will run every other Thursday throughout October and November, discussing the most pressing issues in digital asset regulation, compliance, and market maturity. If you enjoyed today's event, we hope that you can also join us for upcoming panels. We'll send you an email following this session with more information about what's to come. My name is Alyssa Ostrov, and I'm the Chief of Staff at CryptoCompare. This year, DACOM is proudly brought to you as a joint effort between Solidus Labs and CryptoCompare, in partnership with Global Digital Finance. Before I introduce today's speakers, just a few quick words about our hosts and who we are. Solidus Labs offers the first comprehensive crypto-native market surveillance and risk monitoring hub tailored for digital assets. Crypto businesses globally rely on Solidus's solutions in order to apply for licensing, attract institutional investors, protect their users, and grow faster and safer. CryptoCompare is a leading digital asset market data company that caters to corporate, government, and retail clients. CryptoCompare's premium data and analytics provide a comprehensive, granular overview of the market across trade, order book, historical, social, and blockchain data. Now I have the great honor of introducing our esteemed guest for today's event, Commissioner Dan Berkovitz. Mr. Berkovitz was nominated by President Trump to serve as a commissioner of the Commodity Futures Trading Commission in April 2018. He was unanimously confirmed by the Senate in August and sworn into office in September 2018 for a 5-year term. Prior to his appointment, Mr. Berkovitz was a partner and co-chair of the Futures and Derivatives practice at the law firm WilmerHale. He was also an adjunct professor at Georgetown University Law School and vice chair of the American Bar Association Committee on Futures and Derivatives. Mr. Berkovitz served as general counsel of the CFTC from 2009 to 2013. While serving in this role, he was the agency's deputy representative to the Financial Stability Oversight Council. Before the CFTC, Mr. Berkovitz was a senior staff lawyer for the U.S. Senate Permanent Subcommittee on Investigations. He also served as Deputy Assistant Secretary to the Department of Energy's Office of Environmental Management. Joining Commissioner Berkovitz in today's fireside chat is Asaf Meir, founder and CEO of Solidus Labs. Thank you for joining us. Asaf, I'll let you take it from here.
Thank you, Elisa. Much appreciated. I think we didn't mention the most important fact about Commissioner. We just discovered in the green room while waiting that my wife and Commissioner went to the same college of Princeton and actually majored in physics. So it's a very interesting discovery. Thank you, Commissioner, for joining us today. This is a critical dialogue between the regulatory landscape as well as the industry participants that are eager to hear your thoughts about different issues we'll be raising today. But before we get going and dive deep into the questions that are at hand, Commissioner, I'd love to hear from your perspective and your experience before ever joining in September of 2018 to the CFTC. What did you know about digital assets? What did you learn when you joined the CFTC, and how your views might have changed since?
Well, thank you, Asaf, and thank you, Alyssa, for the invitation. It's a pleasure to be here today at this conference. Perhaps next year we can be together in New York. Next year, New York, right? So we'll see. But thank you for the invitation. It's a great pleasure to be here and talk with you today. So interestingly enough, I was at the CFTC. Right after the financial crisis from 2008, 2009 to 2013. And I don't recall really dealing with digital assets at all my first time at the CFTC. First time I really dealt with digital assets was when I was in private practice, as Alyssa mentioned, at the law firm. And the law firm had clients. We had a number of clients, both startups as well as very established businesses, financial services, large financial services companies wanting to explore various market opportunities that they saw. So, and the questions were, what is the regulatory landscape. So that's really how I became most familiar with it. Obviously, follow the developments in the field as a lawyer in this area, read what the agency is doing and keep track of developments. But I actually had a number of clients who were contemplating startups or expanding existing business lines into the digital asset. So I became familiar with both the challenges facing the industry and very particularly the legal landscape during those years. Obviously, now that I'm back at the commission, looking at it from a regulator's perspective, those years where I was doing it in the private sector really informed me. I think I can understand a number of the challenges that entrepreneurs or businesses are facing in trying to get into this space and maintain compliance.
No, that makes complete sense, and we'll touch upon the points that practitioners in this space are experiencing day to day and in the trenches, as we say. And before we go there, I think there is one topic on everyone's mind that we would like to touch upon, and that's the recent charges against BitMEX. Needless to say, this is a very sensitive topic. It's currently under investigation. So just at a high level, I would love to hear your take on it.
Sure. Well, thank you. So we did file the complaint in federal court against BitMEX several days ago, and that's the copy of the complaint is on our website. If you go look at press releases, enforcement, and scroll down the dates, you can see our press release announcing the charges against BitMEX, as well as a copy of the complaint. So what I'll be telling you is actually in the complaint if you want actually more details. But basically, what we are alleging is that BitMEX operated in the United States, and they had customers located in the United States. And many of the customers were in the United States were masking their IP addresses to indicate they were not, so you could not tell they were in the United States. But nonetheless, we allege that they were operating in the United States with personnel and with customers in the US. So if you operate in the US, you're subject to the US law and the CFTC regulations regarding trading of futures and swaps and retail commodities. So BitMEX, according to the allegation and the complaint, was trading swaps. They were trading futures. They were trading retail commodities, commodity interests to retail participants. So if you do any of those things, if you're trading swaps to U.S. customers, you're trading futures to U.S. customers, you need to trade it on an exchange. That could be a futures exchange, what we call designated contract market, or that could be a swaps on a swap execution facility. So you have to be registered if you're going to offer these things to customers. Similarly, what we allege is they were offering in their retail commodities transactions an extremely high degree of leverage. Yep. If you offer leveraged transactions, you need to register for those activities too in the category that we call futures commission merchants. So they didn't do any of those things, and so we charged violations of our regulations and the Commodity Exchange Act in that regard. Also significantly, we charged violations of the Bank Secrecy Act. The CFTC enforces the Bank Secrecy Act as it applies to futures commission merchants and introducing brokers. The Bank Secrecy Act and the Dodd-Frank Act gave us that authority. So we also allege that they failed to follow Know Your Customer requirements under the Bank Secrecy Act.
Do you think that these charges or those actions in a way represent a paradigm shift from the previously perceived approach? And to kind of reference here, the former CFTC chairman, Chris Giancarlo, he often advocated for the do no harm approach, not to overregulate in order to incentivize innovation, incentivize tech creation, and kind of pushing the envelope forward when it comes to the players that are really working on the front lines of advancing different technologies. Do you think we're seeing a paradigm shift in the mindset of the regulator in regards to those different companies operating in the space?
One of the fundamental purposes Commodity Exchange Act, and what we are charged with doing is to ensure market integrity. But another fundamental purpose, it's in the statute, it's in the law, Section 3 of the Commodity Exchange Act, is to promote responsible innovation.
Yep.
So market integrity and promoting responsible innovation on exchanges and market participants is actually what we're charged with doing. And that's a mission, I think that was Chairman Giancarlo, and he was talking about do no harm and how to approach new regulations. How do we regulate an emerging area, an emerging technology, to not enact regulations or that might prejudice or steer the development of the technology, let the technology development, but at the same time, we need to ensure integrity. Throughout where the law is clear, we will enforce it. So I don't view that as a change, a paradigm shift. I think at any time in the CFTC, we will be aggressively enforcing what is a violation. In regards to what should be the law, that's a separate topic. So I don't really see it as a paradigm shift. I see ensuring market integrity as one fundamental function, and another function is ensuring innovation on the regulatory side. But on the enforcement side, we've always been pretty strict in terms of compliance.
Right. It's not a ask for forgiveness, but it's a ask for permission framework of which we're working. So can we expect more of such charges to come in the future?
Well, I think it's very clear that if you're operating outside the boundaries of the law and what the law requires, we will aggressively enforce it. If you look at on that page that I mentioned, if you scroll down and look at our enforcement actions and look at what they are within the past 12 months, we just completed our fiscal year, so we issued a report on it. You can see, if you look over the past year, our actions in the digital area 5 years ago, there wouldn't have been any, and now we have a considerable number. So where there are violations, we will enforce.
So, Commissioner, what can you share with our audience here today? A word of advice of how to go about advancing trust and credibility in the crypto markets.
We are fortunate here in the United States. We have the leading capital formation markets, our securities markets, and we have the leading derivative markets, the futures markets, the swaps markets in the world. I mean, we're the center, still the global leader in capital formation markets as well as derivative markets. That's due to a variety of reasons. One is the strength of our economy, our entrepreneurial advances here, and the freedom that people have to develop new technologies and bring them to market. But one critical factor that makes our markets the way they are is, you use the words trust and credibility. There's trust and credibility in the markets because of the regulatory system and the system of law that we have to govern those markets. Why do people all over the world come in, give your money on an exchange, put it in the computer? People have trust that it's a valid transaction, that they're not going to be cheated, that they'll get it back. If the price goes up, they'll get the benefit, and it goes down, they'll lose. And with anonymous people, you don't even know who the person is on the other side for a lot of these things. But there's a whole regulatory system behind that makes that happen, and a technology system. But I'm talking about the regulatory system, and the trust and the credibility is that it's an honest market, and that there's a cop on the beat, and that the rules will be enforced. You know that the playing field is level and fair. And that's worked for a tremendous amount of asset classes. It works for equities, it works for gold, it works for all sorts of derivative markets, and digital assets. To be able to take advantage of that credibility and that tremendous power of our markets, join in the market, become part of the market rather than offshore some other system. You might say, well, I'm going to save money. I don't have to comply with all those U.S. legal requirements. But if you come into the U.S. system, you really can get the benefit of the credibility of the entire U.S. financial system. I was at a conference before the pandemic, sitting next to somebody who was a hog producer, He was very concerned about competition from China.
Mhm.
Corn, corn is priced on the Chicago Board of Trade, and he has to, he is obviously buying a lot of corn to feed his hogs. But China is huge corn market over there. There's a lot more hogs in China than there are here, and he's worried about competition from the Chinese who are trying to set a market for corn. Price of corn in China, what they're feeding hogs in China, is still the benchmark price is in Chicago, and that's the strength of the U.S. markets. So and he said, why is the benchmark staying here? Why do you think the benchmark is staying here in Chicago, even though the bigger market may be over there? And I said, well, part of it is the trust and credibility in the U.S. market. So it's a very strong market.
You said that, in other asset classes, this strength of the regulation really created a capital formation that is one of the strongest. Completely agree. As a derivatives and futures expert, do you think that there are other newer challenges that the digital asset space poses, or are the challenges similar between the asset classes that we know from the traditional space versus this new emerging one? I think we spoke about essentially the kind of high-level approach of the CFTC, a recent enforcement action, but I want to dig a bit deeper into the challenges that you might think are kind of newer in the space of this evolving crypto market.
Right. Well, that's an excellent question. One of the things that I really like about I've enjoyed through the years and working in this space is the variety of commodities I've been able to deal with. Each commodity that we deal with, one thing in common that all the commodities that we deal with at the CFTC have is they're all different. Okay. Yeah. You might think, well, there's the agriculture markets and the energy markets, but corn and soybeans and cotton are totally different commodities. I mean, they're coffee. I mean, how these commodities are produced and traded in the global markets are all very different. What goes into the price of cotton and the cotton industry is very different from oil or gold. We also have financial futures. If you look at the history of financial futures, what the Chicago Mercantile Exchange did to develop those in the 70s, bring an entirely new class. They weren't physical commodities. Commodities that we dealt with used to be just physical commodities. And the Chicago Mercantile Exchange has had the idea of what's now commonplace financial commodities, interest rates, S&P 500, euro dollars, whatever. And that was revolutionary at the time. And then we had swaps. And how do you treat swaps? What are they? Are they futures? Are they different? Each one of these things has its own challenge in bringing it to the market. And it's like, you take it for granted today, some of these contracts, the oil contract. Oil wasn't traded until 1983. You think about it, the oil industry had been around for 100 years before we actually had a futures contract on it. And it was a challenge of getting each of those. And each of those commodities, the financial futures, the swaps. We went through actually a financial crisis before we got it right on swaps, how those should be regulated. But there's a tremendous amount of work went into, for example, getting financial futures and financial commodities to trade the same way as corn or soybeans. Digital has its own unique set of challenges, but every commodity has had those challenges in terms of getting an established market. Now, on digital, it's not like gold where there is a thing out there, and even though there may be different purities or whatever, but it's still basically gold. One of the challenges on the digital asset world is just the tremendous different types of digital assets. There's a whole entirely different business models. There's centralized, there's decentralized, and it's not a thing. It can be a computer code. So it has a whole set of new challenges, but we have to work through those. None of the challenges and all the other commodities have been insurmountable. So I think the challenges we're facing today are unique, but we've faced similar types of challenges, and working together with the industry, we've overcome them, and now we have very successful markets in all these things.
Yeah, I can share from our perspective and the industry's perspective when we're talking to market participants, clients' perspective. You know, what we're seeing is that I think some of the challenges they're facing are, whether if it's even to the low levels you mentioned, it's the different technologies, so different data structures are being produced and needs to be surveilled. The lack of data standardization, the different trading workflows, the different client segments. There's much more retail involvement here. So yeah, the challenges are really interesting, and I do agree that it's almost just the next challenge of the industry to solve. And you mentioned earlier the Digital Commodity Exchange Act. I'm curious, do you think that, it was introduced a few weeks ago, it's still going through Congress. Do you think that this act might address some of the concerns? And maybe for background, the act is looking to unify some of the requirements for operators to have on a federal level a standard registration process instead of going through state by state regulation. Do you think that this act might help alleviate some of those unique challenges in the world of crypto here in the US?
Well, so on the future, so let me draw the distinction.
Yeah.
Digital Commodity Exchange Act, the act, as you mentioned, Asaf, would seek to have a unified federal structure for the regulation of some of these markets, but that would be for cash markets.
Right.
That would just be for what we call the cash markets in the commodity, you're buying and selling, and that right now is regulated really at the state level. You have to get money licenses, and it's a federalized, decentralized federal system, as much of our economic activity is. So we have this both federal and state regulatory systems, and they coexist. On the future side, we have a single regulator. That's the Commodity Futures Trading Commission, and state law is preempted. So where does the industry want to go in terms of, do you want to, does it, I know I'm speaking, there's not a single monolithic thing out there, but it's something that there would need to be a national consensus on whether we want a centralized system or continue the federal system. And that this has been debated for various issues for since the founding of the Republic and the Constitution and Hamilton and Jefferson and whatever. So one of the things, it would be a significant change in our mission. Right now, we're a derivatives regulator. We regulate the derivatives markets. When I use the word regulate, in this context, I'm meaning establish regulations for, like an exchange. If you want to trade futures or you want to trade swaps on something, you put it on an exchange, and that exchange is regulated by us, preemptively, exclusively of the states. Yeah. If you just want to trade the underlying commodity, you just want to trade corn, we don't regulate it. If you want to trade corn futures, we regulate it. However, we do have anti-fraud and anti-manipulation authority over commodity transactions. So just the sale of corn from two people, theoretically, we have anti-fraud and anti-manipulation authority, but we can't promulgate regulations telling anybody how to trade it, corn or flat out commodities. The Digital Commodity Exchange, the law that's in Congress, would actually give us authority over the cash market rather than the derivatives market. That would be a significant expansion of our responsibilities. We have barely enough resources and funding from Congress. It's exclusively funded right now. We're virtually the only financial regulator that's funded solely through tax, pretty much, 90-something% through taxpayer money rather than a fee on the market. So if we were to have, this would be a significant new responsibility. One of my, I believe if we were to get the new responsibility, somebody would have to pay for it, step up and pay for it. So it would be a significant expansion for us, and I'm interested to see also, does the industry want a centralized one-stop, or do you want to have more of the decentralized, like interstate commerce is for many items? So I'm looking forward to that discussion.
No, that is interesting. I think that from, again, our audience that is with us here today, I think that's something that's been, going on in the different kind of forums and chatter, and created a lot of, I would say, positivity. I think that having a one-stop shop, as you say, regulatory speaking, to get approval might make things a bit easier. But you touched upon the CFTC and the difference possibly from the CFTC to, let's say, the SEC. Something I wanted to bring up is the question of the Bitcoin ETF. Of course, it's under the SEC jurisdiction. I think one of the greatest challenges they keep on mentioning in the rejection letters for the ETF Bitcoin is the lack of shared surveillance, is the lack of, or simply saying, understanding how a bad actor might be manipulating the market on multiple venues. While it's under the SEC jurisdiction, I would love to hear your opinion as a commodities regulator. What do you have any view on that type of, on the ETF Bitcoin question, and the concerns and the challenges around that?
I'll leave the Bitcoin. I'll leave the ETF question for the SEC, whether they have the confidence in the cash market to support an ETF. Their statute and their law and what they need to make a finding to permit an ETF is different from what we need. But fundamentally, we also rely on the cash market for our derivative markets pricing. The whole point of the derivatives is to, as the name suggests, a derivative of the cash market, but the two prices end up having to converge. And the risk management function of our market only works if the price of the derivative, when the contract expires, like a future contract, converges to the price in the cash market. So you need ultimately a cash market price that is reliable for our contracts to work as well. Our standards for that pricing are different from the SEC as a technical matter, but fundamentally the question's the same. We both rely on the cash market for our derivative markets, and you need to have integrity in the cash market. When we first approved, the agency first approved futures, Bitcoin futures, we put a number of, we had heightened scrutiny and we had a number of conditions that we put on the contract in terms of the exchange, monitoring the cash market, ensuring that the inputs into the settlement price from the cash market had the integrity of those prices, and there was monitoring of the trading going on. So while their statutory standard and ours are different, we have fundamentally the issue is the same, is the reliability of the cash market, and given the various inputs, the different exchanges, how is that being accomplished, and who's doing the monitoring, and how reliable is the information? So I'm very concerned about that issue.
To me, it's all bubbling to one major issue here, which is the market fragmentation, right? I mean, it has to do with the Digital Commodity Exchange Act. It has to do with the fact that the ETF Bitcoin is not being approved due to the lack of shared surveillance. And continuing on the same note of this fragmentation issue, other industries in our space have done different or created different forums in order to alleviate those issues, whether if it's the Intermarket Surveillance Group in securities or the online lending network for online lending. Even in the case of the CFTC, there's Part 16 reporting for swaps market. Do you think that a form of data sharing agreement between the regulators, the market participants, can help bridge this overarching issue of market fragmentation that has to do with the Bitcoin ETF, has to do with the Digital Commodity Exchange Act, and generally with detecting fraud on a much more nuanced and subtle way? And it's quite a lot,
obviously,
so
yeah.
That's a lot to unpack here. There's a lot to unpack here. So yeah.
Yeah. So yeah, right. There's a lot to unpack. So first of all, on information sharing, we've made tremendous advances with other federal agencies. There's the Securities and Commodities Task Force. We're working with Treasury and FinCEN on Bank Secrecy Act issues. If you look at the cases, the enforcement cases that are being brought, BitMEX, the most recent example, many of these are brought because of the cross-cutting nature of the digital assets involving securities law, involving commodities law, banking law. You'll see many of the actions are cross-cutting across jurisdictions. So there is a lot of a sharing going on, and that's been increasing in years. In terms of and that's on the enforcement side. So somebody gets a tip that there's some bad activity going on. People get together, share it on the task forces. Each agency looks at it. There's sharing of information that gets developed. In terms of active monitoring, this is something, obviously, the way you described it is the way it should be. And if we could get there, yes, let's each get the data, let's share, and let's put it in a, get the folks together and have a holistic view. That is, in concept, easy to state. In reality, hard to do. The agencies were working at it. We've been doing it now for 10 years. I mentioned on the swaps side, for example, trying to get data sharing amongst internationally various regulators and various federal agencies. We had a meeting earlier this week where we signed a memorandum of understanding with the Office of Financial Research, which is an office in the Treasury Department that was set up in the Dodd-Frank Act to do exactly what you mentioned with respect to swaps data coming from federal agencies, that various federal agencies would feed data into the Office of Financial Research, and there'd be a centralized office that would study the data, report to the Financial Stability Oversight Council, the FSOC as we call it, which is composed of all the federal financial regulatory agencies. And the FSOC would look at the data, and this way there would be a holistic view of the financial markets, and there sort of they create a dashboard. You could tell about emerging risks. You go onto the Treasury website, you can look at the work of the Office of Financial Research and see the FSOC reports. So the progress is being made, but we signed this MOU. It's our second MOU. We did the first one 10 years ago to share information. Clearly, there's a lot more work to do.
Yeah,
I would not represent that we have the dashboard or we can spot emerging risks. And we've been at it for 10 years in the Dodd-Frank Act, but we're working to get it. So ideally, this is the type of system you would want in the digital asset world too. But the challenge that you've just discussed, the decentralization, part of it's state, part of it's federal, it's global. How do you get a handle on it are really significant challenges. Right now, there's a good amount of sharing. As I said, once we find out something might be wrong, people get together. In terms of spotting it in advance, there's a lot. We're much further behind than that.
I can share with you. I think a lot of our audience already knows. We're working with a lot of market participants to advance the industry forward in that regard as well. And some of the challenges you mentioned now, whether if it's just the natural progression of such initiatives, which tends to be relatively sluggish, but also very difficult challenges when it comes to data, quite literally processing different data structures from different ways companies are doing things. So the market fragmentation, when it comes to digital assets, also presents itself in ways that are very different than traditional markets from our experience, right? There's no fixed protocol in our digital asset space where everyone is persistent trading data the same way. So it's fairly easier to consume possibly by a data repository that is centralized. So we're big advocates for possibly creating such a solution to advance the market forward and create further visibility. And being able, as you say, for a regulator to be able to understand what is the market risk and as different entities are involved in it together. And taking you also mentioned earlier, Commissioner, the different enforcement actions you've also taken over time from on other traditional entities. My question to you, so last week, I believe, there was another enforcement action against JP Morgan, almost $1 billion in fine for a spoofing case. This begs the question, are we over scrutinizing digital assets, considering these things are also taking place in a fairly mature market? Do you think it's less fair or less safe, the digital asset space, considering, again, we're seeing more and more enforcement actions such as those taking place in the traditional space?
Well, no, people are people, and markets are tempting. Markets are tempting venues. There's a lot of money at stake. So we see fraud, we see manipulation in well-established markets. We see them in emerging markets. It's human behavior. It is what it is, and it's been across all commodities, across time. It's a feature. So we have to be vigilant there. One thing about emerging markets, whatever they may be, generally present heightened risks. First of all, there's unfamiliarity with the regulatory system by both market participants and by customers. And I say both in new technologies, and sometimes there can be bubble mentality about it, and people want to get on. Oh, this is the next whatever it is. Get in on the ground floor. This will be the next whatever it is, and I can put my money in and be very successful, or just picking the next winner. So these tend to attract new technologies and market, combined with general market optimism, is generally where you've got to watch out for a lot of people trying to take advantage of other people and get rich quick, and fraud is just more rampant under those circumstances. We do see, not just in this area, but generally in a bubble mentality, or in new emerging technologies that have the promise to be very successful. People hype things up to get investment. Some are honest, some are not honest. So it's just the conditions in any new emerging technology, in any era of extreme optimism, be it just not justified or justified. Even if the optimism is justified, those create fertile ground for fraudsters to operate in, to get people to give them their money. So those conditions, to the extent that they're present in the digital technology space, we have to be extra vigilant. But we don't let down our guard for the, you see it in established firms, in established commodities see these issues. They don't go away, but that risk is heightened in these kinds of conditions.
If I may, Commissioner, do you own Bitcoin?
No, I don't own Bitcoin.
I see. Well, I was just curious as we were talking about those different industries. You mentioned also the decentralized nature of things. I wanted to take you to a little bit more of a futuristic question here. What do you think of decentralized finance? It's one of the, I think, hottest segments currently in the digital asset space. Where does it meet the CFTC? Have you even went down the rabbit hole of thinking what that might mean for a regulator? Love to hear your thoughts about
that's a great question, and I'd love to get feedback on that from the market. The CFTC, our whole system, actually, the regulatory system that we have, much of it is based on regulating intermediaries. We don't regulate the end customer. If you want to trade a futures contract, you go onto an exchange through a futures commission merchant or an introducing broker. If I'm talking about a retail customer, for example, I mean, if you're a Goldman Sachs, you can go and trade for yourself. But people, mere mortals, have to go through intermediaries to get to the exchange. If you're not a member of the exchange yourself, So you go through a futures commission merchant, you go through an introducing broker, perhaps, to get to the FCM or whatever. And you have to play by the rules of the exchange. And I mean, you can't commit fraud either. There's thou shalt not do this. But generally, the point of contact of our regulation is, in terms of customer protection and is through the intermediaries. That's where the heavy regulation really is. It's on the future side through the intermediaries. We have futures commission merchants, we have introducing brokers, we have the exchanges, obviously. Commodity pool operators, if you pool money, if you take money from investors and then trade commodity futures, what we call, or swaps, commodity interests, you're regulated as a commodity pool operator. If you want to trade retail foreign exchange to retail customers, you have to be regulated somehow, or your own category of retail forex dealer. So we regulate intermediaries. Now we had a proposal. There was a proposal a few years ago, and there's one, actually a different one pending now before us. There's been concern about algorithmic trading. The algorithmic traders, the algorithms they use can be market disruptive. We've seen flash crashes, things like that. So maybe the CFTC should regulate these algorithms, how you use algorithms, and there should be more safeguards. The question comes, how do you do that? You can either regulate the exchange, say the exchange shall tell its traders to do XYZ when they're using algorithms, or you can tell people, if you use an algorithm, you need to have the following checks on your algorithm. If you use an algorithm to trade, you can only do this, and apply the regulation directly on the algorithmic traders and make them register. If you're going to use an algorithm that's automated trading, you have to register with the CFTC. When we proposed that, to a certain extent, there was a huge outcry. Creating new registration categories of algorithmic traders. We'd be regulating these market participants.
I can imagine would be a challenge. But yeah.
So
deep level of code, code bases. Yeah. Mm-hmm.
They didn't want to. One of the basic concerns that they had was access to the code. They didn't want, if they were regulated, to get access to the code, and people don't want to give up their code, understandably. So that was a very fierce debate. There's a proposal before us now, which is somewhat more principles-based rather than prescriptive in terms of how it would do, and it's really directed more to the exchanges and the futures commission merchants, what they must do, rather than make a separate registration category. So when we're talking about decentralized finance, and if we have a financial system without these intermediaries, then what is the point of regulation? Where do we focus? Where do we focus the regulation and ensure market integrity? If it's traded on some type of exchange or through an exchange, even though there's no intermediaries, if it's peer-to-peer trading through an exchange, we can regulate the exchange. But if there's just this peer-to-peer network that doesn't really go through any intermediary, that presents a challenge because it's not really the model that we have now. So right. That's a great question. What would we do in that regard?
So then, you start going into the realm of nodes and the actual network, oracles, the different components within the network that facilitate the exchange of digital assets. And, I can share, I do think the audience may not like this. I do think that DeFi is far from us to materialize into anything of great volumes anytime soon, but those are definitely items that, the industry is asking us, what is the right way to regulate, or to at least create a compliance program internally to make sure that we are up to standard, knowing that we want to engage in a decentralized system here. And go ahead.
No, I would say so. I mean, I think what you're mentioning in terms of unique challenges. One difference, as I said, each challenge is unique, but one significant difference between this challenge and previous ones it's one thing, for example, I mentioned oil. The oil contract didn't come on until 1983. So how do you structure that? And financial futures didn't come on until the 70s. But there were, those were in, oil had been in existence for 100 years. There was a use for oil. We knew what the oil market was. The interest rates, there was a market there that had already been developed. The question was, we now want a derivative market on an existing market. What we're talking about here is the underlying market and the system is still in development, and in a large extent still emerging. How it's going to end up, the questions that you're talking about in terms of the nodes and how to set it up. It's not as if there's a digital commodity and let's figure out how to do a future on it. What is the entire system or the network? So it's a chicken and an egg thing that we're faced with there, which makes it interesting, to say the least. So I just welcome the continued dialogue back and forth on it.
Yeah, and as I mentioned, this is definitely more of a kind of forward-looking question. I can share that the vast majority of I can say our clients, other companies in this space that are facilitating trades are of course all working in a centralized manner, order book. But discussing technology and innovating again and striking a balance between innovating but not push the line too forward. Commissioner, you were a keynote speaker at the ISDA in 2019 conference. You often speak about regulatory technologies, the need to include more and more financial technology innovation into the market, into the detection capabilities. I can share from our own experience that oftentimes I have to keep my head of data science at bay. He would like to push forward, create neural networks to detect market abuse anomalies we haven't even heard about before. And I have to tell him, hold on, eventually we're going to have to explain all this to a regulator. Let's keep things fairly basic for the time being, at least. How would you say the industry should strike a balance also when we're creating compliance programs, compliance protocols, compliance algorithmic detection models? What would you say is the right balance here?
Well, first of all, I wouldn't want anybody to hold back on account of us. We should not consider us a reason not to go ahead with what you think, technology needs for you. We've got a lot of smart people in the agency. I'm very proud of our agency and our capabilities. But we're not on the front lines, okay? You and your folks are on the front lines, and you can put somebody who's on the front lines, and we can hire them, and a week later, they're not on the front lines anymore, and they're not at the cutting edge, and then they have to have it explained to them. So it's just where we sit, and also I would say that when you're talking about a system that you would want to use, for example, to satisfy a certain compliance requirement, the extent to which it may be novel and complex and untried, and there's not a track level, that may indeed be a factor for us in terms of approving it. Obviously, if there's a model that you can fit in and say, well, this model's worked for, you've approved it in cases A, B, C, that'll make it easier. But if you've got a better mousetrap over in your technology for whatever. By all means, engage with us on that, because we've got to move forward. Our system, I mean, we have adapted. We've adapted the whole marketplace. Look at latency, the latency issue. I mean, we've enabled. We have the speed at which somebody can trade from New York to Chicago or Tokyo to Chicago or whatever, and people can build all sorts of, and have, they spent literally billions of dollars in investing in technology to reduce the latency. And what did we need to do as a regulator? Well, as a regulator, we needed to be sure that however people were getting there, that there was space in the building next door to the exchange or wherever it was. If the exchange is going to give out its space and next door to the servers, that it give it out equally or whatever it is. So we can adapt. Don't hold back on account of us.
We're reaching the end here, and I do want to ask you a few questions, into the future of digital assets. So I think it was last week when Chairman Jay Clayton said that all stocks may one day be tokenized. So in the long run, what sort of impact do you think digital assets may have on the commodity and futures market?
Well, I think, I don't know exactly. I'd be hesitant to predict, and I have no predictive capability in terms of exactly which of the use cases will emerge and what is. But our derivative markets are fundamentally based on successful commodity markets. So whatever use cases emerge down the road, however these are used and integrated into commerce, I think our markets can successfully accommodate those uses and will grow along with those uses.
Let me also ask it in a different way, I would say. As you know, this is our second DACOM summit online. Of course, last year we were in New York in a conference with Commissioner Hester Peirce. What do you think we'll be talking about in the third DACOM next year and in DACOM 2030?
I think we'll be talking about those particular use cases. I don't know what they will be, but I think we will be talking about how to adapt our regulatory system to some particular case. I think with all the work that's going on, that we'll be having a more concrete discussion a year from now, and 10 years from now as well.
Understood. And from even from a higher level perspective, right? Taking a higher approach here, between Bitcoin will be the most used international currency to who would even remember Bitcoin or blockchain in 10 years? Where do you stand on that spectrum?
Oh, I don't think any of this is going away. I think that there will be digital assets are here to stay. So I don't think whether Bitcoin or whatever it is, however it emerges, I think it's here to stay.
Yeah, I mean, I couldn't agree more. Of course, that's why we're in business. And I can tell you, I think a lot of different folks we meet, to them, the hype of things that occurred in 2018, 2017 was basically the race towards the finish line, where, well, really today, I think the infrastructure is being built very responsibly. And a lot of folks regarding this as the race to the starting line. I think, as you mentioned right now, 100% agree with you. The use cases are yet to be fully unraveled and discovered. The forms in which digital assets can evolve. I can share that a lot of our clients are speaking with us about prime service around the creation of prime services around their exchanges, additional cross-market and asset surveillance capabilities in order to usher in the very anticipated one day, hopefully, institutional adoption, and other assets such as what we've discussed, ETF and such. So I'm with you on the same page where we're at the very beginning, and it's very hard to predict what is it we'll be discussing about next year or in 10 years. I think we may have some questions from the crowd. I would love to bring up in our last 5 minutes.
Okay.
So I think one question here that popped on the list was, I would be curious to ask you that. One of the commonly accepted sentiments someone asks in the digital assets regulatory space is that the U.S. federal regulators are somewhat behind from the rest of the world. There's a regulatory arbitrage. We see already different crypto companies moving away and creating their legal jurisdiction elsewhere, as you mentioned in the beginning of our conversation. Do you think that sentiment is correct? I'd love to hear your take on that.
Well, I guess I'm not sure what it means to be behind. and I would just say that whether it's easier or more difficult in another jurisdiction to set something up, I mean, perhaps it could be easier to get a business going in another jurisdiction. But I just go back to what I said earlier, that well, we participate. The CFTC, we're in all the international groups, all the standards for regulating various markets, our exchanges, and our general regulatory system. People come to us. Our folks go around the world, or used to before the pandemic. Helping educate on our system. Yep. Well, ours is a rigorous system, no doubt about it. It's to regulate an exchange, to be an intermediary, our money services. I mean, your folks know that the challenges of the U.S. regulatory system. Yep. But I would just, and we're working to facilitate the integration of the new technology into that system. But to the extent that a company wants to trade to retail customers, wants to get on take advantage of our securities markets, take advantage of our derivative markets, that you have to follow the rules. But you get, as I talked about before, the benefits of that. I mean, our our seal of approval, our license carries with it really the security, the trust, and the credibility and the confidence that I think is second to none in the world. So, whether it's easier in some other jurisdiction to get a business going, file papers that they don't have as many details as ours do, perhaps, but they're not U.S. markets, and so there's tremendous benefits for staying here.
Well, there's a reason behind the challenges that are in the way of registering and being compliant here, working in the capital markets. Commissioner, with that, I would love to thank you again for taking a part in this crucial dialogue between regulators and the crypto compliance field. As we like to say, it's a very unique, challenging forum and field to be in. There's new issues that are coming up every day. Hearing from you, your outlook, your insights are incredibly important, and I'm looking forward to continue the dialogue, hopefully in person, sometime not too long from today.
Well, Asaf, thank you very much, and I look forward to continuing this dialogue with you and folks out there who I unfortunately don't have the pleasure of meeting at the conference this year, but please contact me or my office, and if you have ideas on anything that we talked about and how to make it easier and how to adapt our system to these emerging technologies, or questions about how to do it, feel free to reach out to me or the agency. And really, this is an area where we need to work together going forward, because I do believe it's here to stay. And I look forward to continuing the dialogue. So thank you for the opportunity to be with you today.
Thank you much, Commissioner. Thank you.
Bye-bye.
Bye-bye.